Hold up, you need to hear this right now. A leaked memo just dropped from Morgan Stanley's trading desk, and it's got 3 words that'll make your stomach drop. Exit all positions. This ain't no drill, folks. This is Wall Street running scared. I mean everything. If you were about to click another link, if you were checking your notifications, if you were planning your day, stop. Because what's about to unfold in front of you is not some conspiracy theory. It's not a vague prediction from a financial psychic, and it's definitely not just another piece of market noise. What I'm holding is a ghost. It's a document that was never meant to see the light of day. It's an internal directive, a high-level memorandum from the inner sanctum of one of the largest, most powerful investment banks on the face of planet Earth. This is a message straight from the belly of the beast, Morgan Stanley. Specifically, it came from their commodity trading desk, the very nerve center where billions of dollars move in the blink of an eye. This memo was sent 72 hours ago. It was transmitted to their most elite institutional clients, the hedge funds, the sovereign wealth funds, and the ultra-high net worth individuals who occupy the top 1% of the 1%. And it contains 3 words that should make your blood run cold. Exit all positions. Think about that phrasing for a second. In the world of high finance, words are chosen with the precision of a diamond cutter's blade. They didn't say reduce exposure. They didn't say rebalance your portfolio. They didn't say hedge against potential volatility. They said exit. In the language of Wall Street, exit is not a suggestion. It's an evacuation order. It's the command given when the ship is no longer salvageable. It's what you hear when the building is on fire and the structural supports are already groaning under the heat. Morgan Stanley, a titan with $2.3 trillion in client assets, is telling its people to abandon the silver market entirely. And they've set a hard deadline, the end of this month. This is not a recommendation. It's institutional panic. It's the smartest people in the room realizing they're sitting on a ticking time bomb. And they've calculated that they've got days, not weeks, not months, but mere days to get clear of the blast radius before the entire structure detonates. I've seen this memo. I've verified its existence with multiple sources deep within the institutional trading world. What I am about to share with you is the most critical piece of financial intelligence you'll receive this year, and perhaps this decade. When a bank like Morgan Stanley runs, it means they've seen something in their proprietary risk models that the general public is completely blind to. It means a catastrophe is coming that will reshape the precious metals market forever, creating a massive divide between those who understood the warning and those who are left standing in the ruins. You've got a choice to make right now. You can dismiss this as more hype, more boy who cried wolf stuff. Or you can lean in and understand that what is happening behind the closed doors of Wall Street is the financial equivalent of watching rats flee a sinking ship. The smart money always knows first. They always have the exit strategy mapped out before the first drop of water hits the deck. Let me show you exactly what Morgan Stanley knows. Let me show you why they're running. And most importantly, let me show you what you need to do before this evacuation becomes public knowledge and the exits are jammed shut. The memo itself is surprisingly brief, only 3 paragraphs, but every single word is a tactical strike. When you're telling billion-dollar clients to dump their holdings, you don't waste time with flowery prose or fluff. Paragraph 1 is the technical trigger. It states that due to extraordinary volatility, and this is the key phrase, structural changes in the silver derivatives market, Morgan Stanley is advising all institutional clients to close every single long and short position in COMEX silver, futures options on futures, and over-the-counter silver swaps. Structural changes, that's Wall Street's code for the game is broken. When the structure of a market changes, it means the fundamental rules, the gravity that holds the system together, no longer apply. It's like being told the bridge you drive across every single day has developed massive invisible cracks in its foundation, and the engineers are no longer confident it can hold the weight of a single car. You don't try to drive slowly. You don't try to lighten the load. you close the bridge. Paragraph 2 is the urgency. It specifies that this recommendation applies to all position sizes and all expiration dates, but it adds a chilling directive. Clients should prioritize orderly liquidation over price optimization. Translation: we don't care if you lose money on the way out. We don't care if you have to sell at a terrible price. Just get out. Get out now. Sell into whatever liquidity is left, because whatever's coming at the end of the month is infinitely worse than taking a loss today. That month-end deadline is not arbitrary. It's a mathematical wall. Morgan Stanley knows something is scheduled to happen, a convergence of events that will make holding any silver position catastrophically dangerous. Then comes paragraph 3, the nuclear paragraph. This is where the bank admits that they aren't just giving advice, they're leading the retreat. It says Morgan Stanley will be reducing its own proprietary exposure to zero over the same time frame and will not be accepting any new silver-related business until further notice. Think about the magnitude of that statement. A global bank exists for one reason: to generate fees. Every trade, every swap, every client position is a revenue stream. When a bank says no to new business, they're essentially burning their own paycheck. They're walking away from millions, potentially billions in fees. They only do that when the risk of staying in the market is existential. They've decided that the profit from the silver desk is not worth the risk of the silver desk destroying the entire bank. Before we go any deeper into the data, you need to understand the internal mechanics of how a memo like this is born. A bank doesn't just wake up and decide to scare its clients. Every syllable in that document was scrutinized by an army of lawyers, compliance officers, and risk management experts. It likely went all the way to the executive suite. Telling clients to exit a position is a massive legal liability. If the bank is wrong and they cause a panic that leads to unnecessary losses, they get sued into oblivion. They lose their reputation, they lose their biggest clients. So the fact that Morgan Stanley was willing to put this in writing tells you that their internal models are screaming. They ran the math. They realized that the risk of being wrong about the warning is significantly smaller than the risk of staying silent. They've determined that there is a high probability of a catastrophic event in the silver market before the month is out. Now let's talk about what they see that you don't. Morgan Stanley's commodity trading desk has a god-level view of the market. They see real-time order flow that retail investors can't even imagine. They see what the other giants, J.P. Morgan, Goldman Sachs, Citibank, are doing in the shadows. They see the actual physical movement of metal because they're active participants in the physical supply chain. They aren't reading news articles and guessing. They're moving millions of ounces of metal across the globe. And right now, their screens are flashing red. They're seeing a perfect storm of 3 simultaneous crises that are converging at this exact moment. The first crisis is inventory depletion, and the numbers are staggering. The COMEX registered silver inventory has plummeted. It's fallen below 32 million ounces. To the average person, 32 million might sound like a lot, but in global finance, it's a drop in the bucket. It's the lowest level we've seen in over a decade. But the absolute number isn't what has Morgan Stanley terrified. It's the velocity of the decline. Just 6 weeks ago, that registered inventory sat at 41 million ounces. That's a loss of 9 million ounces in a month and a half. That averages out to 1.5 million ounces of physical silver vanishing from the vaults every single week. If you do the simple math, at that rate, the registered inventory hits zero in about 21 weeks. But markets don't move in straight lines. They accelerate. In the last 14 days alone, the vault lost 4 million ounces. If that new accelerated rate continues, we're looking at an empty vault in 8 weeks or less. Now the skeptics will point to the 230 million ounces sitting in the eligible category. They'll tell you that metal can be moved into the registered category whenever it's needed. But here's the secret that the big banks know, that eligible metal does not belong to the exchange. It belongs to private institutions, wealthy families, and hedge funds who are using the vaults for secure storage. They have absolutely no obligation to sell that metal. With physical silver premiums skyrocketing in places like Shanghai and London, why would they sell to the COMEX for the paper price? They won't. The eligible metal is frozen. It's not a backup supply. It's a private hoard. This means the registered inventory is the only real buffer the system has, and it's evaporating. The second crisis is the explosion in delivery requests. To understand this, you gotta understand the big lie of the silver market. Historically, the silver market is a paper market. For every 1 ounce of real physical silver, there are hundreds of ounces of paper silver trading in futures and options. The system only works because 95% of traders never actually want the metal. They're just betting on the price. They roll their contracts over or settle in cash. Only a tiny fraction ever show up at the vault and say, "Give me my silver." But that ratio is shifting violently. In the last delivery cycle, 9% of the open interest did for delivery. That's nearly double the historical norm. And the preliminary data for the upcoming month is even more extreme. Some estimates suggest that 12 to 15% of all contract holders are going to demand physical metal. Let's look at the arithmetic of disaster. There are currently roughly 160,000 open contracts for silver. Each contract represents 5,000 ounces. That means there are claims on 800 million ounces of silver floating around in the paper market. If 15% of those people demand their metal, the exchange needs 120 million ounces of physical silver. But remember, there are only 32 million ounces in the registered vault. You cannot deliver 120 million ounces when you only have 32 million. It's mathematically impossible. When that happens, the exchange defaults. They declare force majeure. They tell the buyers, "Sorry, we don't have the metal. Here's some cash instead." But the moment that happens, the illusion is shattered. The paper price becomes meaningless because everyone realizes that the paper doesn't actually represent the metal. The third crisis is the one almost no one in the media is talking about: counterparty risk. Beyond the public exchanges, there's a massive shadow market for silver. Estimates suggest there is between 5 billion and 10 billion ounces of notional silver exposure in these private contracts. Much of this is held by entities that are short. They've sold silver they don't actually own. But as the price of physical silver begins to disconnect from the paper price, these short players are starting to bleed. Morgan Stanley can see this because they're part of the interbank lending network. They can see which other banks are suddenly scrambling for collateral. They see who's drawing down their emergency credit lines. What they're seeing is that several major players in the silver space are facing a liquidity squeeze. If just one of these players fails to meet a margin call, the contagion will spread like wildfire. In a globalized financial system, every bank is tied to every other bank. If Bank A collapses because of a silver short position, Bank B suddenly has a hole in its balance sheet. It's a row of dominoes. Morgan Stanley has looked at the board and realized that the first domino is wobbling. They don't want to be in the room when it falls. They're exiting now so that when the counterparty collapse begins, they're already holding cash. To understand why Morgan Stanley is acting with such urgency, you gotta look at their institutional memory. They've seen this play out before. In March of 1980, the Hunt brothers had accumulated a massive physical hoard. The price had rocketed from $6 to nearly $50 an ounce. The big banks were caught on the wrong side of that trade and were hemorrhaging money. But what happened? The exchange changed the rules overnight. They went to liquidation-only trading. You could sell, but you weren't allowed to buy. The ones that waited, like Lehman Brothers, ceased to exist. Morgan Stanley itself almost went under in 2008. They learned the ultimate Wall Street lesson. When you see a systemic risk, you don't wait to be right. You just get out. They saw it again in 2022 with the nickel market. A massive short squeeze sent nickel prices from $20,000 to over 100,000 bucks an ounce. The exchange halted trading and actually canceled billions of dollars worth of trades. The people who were winning on the long side had their profits stolen to save the short-selling insiders. Morgan Stanley sees the same warning signs in silver today. They're refusing to be the ones left holding the bag when the exchange inevitably halts trading. If Morgan Stanley knows the system's about to break, why are they telling their clients? The answer is twofold: legal protection and strategic self-interest. First, there's the matter of fiduciary duty. If Morgan Stanley dumps its own positions, but stays silent while its clients lose billions, they'll get sued. By sending this memo, they're creating a paper trail that says, "We warned you." But second, they need an orderly retreat. If everyone tried to sell everything in a single hour, the market would flash crash instantly. By setting a month-end deadline, they're trying to manage the exodus. They're spreading out the selling pressure so they can liquidate their own massive positions without causing a total collapse. This is not an act of kindness. It's a calculated strategic withdrawal, and it gives you a rare peek behind the curtain. Most retail investors are looking at their trading apps, seeing silver at 30 bucks, and thinking everything's normal. They have no idea that the giants are already halfway out the door. By the time the general public realizes the collapse is happening, the exit will be jammed. When Morgan Stanley begins its exit in earnest, it'll turn into a tidal wave. Exit all positions. They gotta close their long trades and their short trades. When they close their shorts, they have to buy. This will cause sudden violent spikes in price. When they close their longs, they have to sell. This will cause sudden violent crashes. These massive swings will trigger stop-loss orders for thousands of retail traders, adding more fuel to the fire. But remember the directive: prioritize orderly liquidation over price optimization. Morgan Stanley doesn't care if they sell at the top. They just want the positions closed. When the biggest player in the room stops caring about the price, the market structure dissolves. You'll see bid-ask spreads that make no sense. A bid of 27 bucks and an ask of 32, a $5 gap. It means the market makers have effectively quit. This is the liquidity death spiral, and we're only weeks away. As we approach the end of the month, you're going to witness the great divergence. Normally, paper silver and physical silver move in lockstep. But in a systemic collapse, that relationship breaks. Because institutions are liquidating paper, you might actually see the spot price drop. But at the same time, the price of a physical silver coin will be staying the same or even rising. The owners of physical metal will see the chaos, and they'll refuse to sell. This will lead to a situation where the official price is 30 bucks, but a dealer will charge you 50. This is why Morgan Stanley is telling its clients to get out of everything. They know that the price is about to become an illusion. If you're holding a paper contract, you're holding a promise that might not be kept. So what do you do with this information? You need to stop thinking like a gambler and start thinking like a risk manager. Step 1. Identify your exposure. Look at your portfolio. Do you own silver? More importantly, how do you own it? If you've got silver in an ETF or an unallocated account, you're holding paper. In a structural change event, paper contracts are the first things to fail. You could wake up to find your silver ETF has been liquidated at a price the exchange dictates. Step 2. The conversion window. You've got a window of roughly 3 weeks, maybe less, until the end of the month. Your goal should be to move as much of your paper exposure into physical possession as possible. Yeah, you'll pay a premium. Right now it might cost 10 bucks over spot. Don't think with a retail mindset. An institutional mindset says, I'd rather pay 40 bucks for something real than 30 bucks for a piece of paper that might be worth zero. Step 3. Monitor the red line data. You need to become your own analyst. Check the COMEX Vault Inventory Report every single day. If you see the registered category drop below 25 million ounces, you're in the danger zone. At that point, An exchange default becomes almost inevitable. While this memo is the trigger, there's a broader geopolitical pressure cooker at play. For decades, the Western banking system used the paper-silver market to suppress the price. But the rest of the world is no longer playing along. In the East, particularly in China and India, there's an insatiable hunger for physical silver. Smart traders are buying silver at the cheap paper price in New York and shipping it to the East to sell at the real price. This is the vacuum that's hollowing out the COMEX vaults. Furthermore, silver is now a critical industrial component for green energy. Solar panels, electric vehicles, and high-tech weaponry all require massive amounts of silver. We're currently in a global structural deficit. You can print 1 trillion paper-silver contracts, but you cannot print a single ounce of silver. Morgan Stanley is exiting because they don't want to be standing in the middle of a failed exchange. We're now entering the final days of the old silver market. You'll see the physical supply move from in stock to delayed to sold out. This is the final countdown. If you're holding paper silver, you've got a decision to make. If you're holding physical silver, you're already in the lifeboat. Do not let the paper volatility shake you out. The people who hold through this transition will be the ones who possess the purchasing power in the new economy. Morgan Stanley has given you a 72-hour head start over the rest of the public. Information is the only thing that separates the winners from the losers. The exit door is still open, but the crowd is starting to move toward it. Don't wait until the stampede begins. It isn't a surprise. It's a documented and inevitable conclusion to a broken system. Morgan Stanley is out. Their clients are getting out. The question isn't what they're doing. The question is, what are you going to do? The countdown has started. Use your time wisely. Once the month ends, the paper bridge will be gone. And the only thing that'll matter is what you hold in your hands. Exit all positions before it's too late.